Right, so thanks up. So I guess we're sort of telescoping our way in a way. At least giving you the ground zero of where we think the issues are. David sort of tried to put that into context for the world, and now what I want to try and do is give you a bit of a feel for what do we do in a portfolio, because it's always why we started. Part of the reason for starting Nucleus was you've got that that age-old problem in that identifying problems is often easy, and finding what not to invest in is a lot easier than finding what to invest in. And so what I wanted to do is give you a feeling for how I'm approaching it or we're approaching it in terms of putting together a portfolio, and hopefully you can sort of pick up something for that, either use for your own portfolios, or give you some comfort if you are investing with us. First, I just wanted to put into perspective so the longer term. So I'm sort of taking another step back, and the way I think of the Australian economy is as we've been through these twin booms, historic booms in terms of the mining is a generational boom. So that sort of led us through the early 2000s. Halfway through that, or a fair way through the boom, we had this big financial crisis erupt, and which made it look like it was all over. And then China stepped in and saved us by those. David showed you the mountains. This huge debt came back in, and off it went again. So sort of briefly interrupted, but it was very beneficially interrupted in that left to its own devices, it probably would have grown big and big and big, and then you get a huge crash, and it's picking up the pieces for years. But we got a bit of a dry run before China stepped in, and that meant that on that next leg up, there was a bit more restraint shown. Then, and it also gave the RBA time to have a bit of a look, to go, okay, what are we going to do next? So the next thing what they wanted was a housing boom. So downward interest rates. You could say that a little bit of looking the other way. I think at one stage Joe Hockey was looking to put a lot of constraints on foreign buyers, and then we switched prime ministers, and all of a sudden that went away. The question about were we a bit more lax on lending than we could have been, quite possibly, and we got this housing boom going. So the big issue though is what next? Like in the big picture scheme of things, what's the next boom we can invest in? And for my part, mining's done for this the next 10, 15 years. You've got to wait for the next a long period of capex, and you've got to wait until people are saying never again, and talking about how terrible returns are. That's a very long boom to get there. I think the most likely for me is some sort of manufacturing and services boom, in terms of actually getting workers into Australia, getting Australian wages to a stage where if you're setting up a services company and you want to hire somebody in Asia, you want to hire a lawyer somewhere. At the moment, you're probably going to hire them in Singapore or in Hong Kong or somewhere like that. You need to be able to go, well, no, Australia is so cheap that I'll stick my next lawyer in Australia. So for that, you need a lower dollar. You're not going to do it with a dollar where it is now. It needs to be at the stage where it's a no-brainer to, yes, Australia's got an educated workforce. We're going to use that to kick it along. And part of, because we went through that phase of this, we let the dollar go so high to temper the mining boom. We lost a whole bunch of our manufacturing capability, which actually means the dollar needs to fall lower before you get that come back in. Because if you've got a factory and you've just wound back on your workers, and then the Australian dollar falls, you can build your workers back up again. If you've closed the factory down and shuttered everything, you need a much lower dollar to say, okay, now it's low enough that I can actually afford to come and set up a whole new factory and start again. So the other thing to note with that as well is we've got this drought ticking along, and so sort of in the back of my mind as well, there's one more sort of negative risk that's to play. So I'm going to talk through what we've done in a portfolio so far, but I just wanted to put it in context because I think we take a relatively negative view on most of the things we do. So we spend a lot of time in the portfolio looking at ranking everything by quality, ranking everything by value, letting the model throw out stocks, and then we spend a lot of time going through those stocks and going, well, no, I don't like that one. And yeah, the model likes that, but I can see why. That's fake value or it's not real quality. And so, yes, I'll talk relatively negatively about it, but I just want to put into context, we have had a very good year in terms of performance. So our international, so this was end of July. We've got the end of August figures, which are almost ready to go. Just sort of playing around to get them right, but that was sort of added another almost 5% to the international. The growth fund, I think, is up sort of 17 type percent. So it's, performance has been very good. But I just wanted to put into context where it is. So this is a dashboard. If you're a member, this is showing a growth portfolio. So we have a bunch of different portfolios, and it's basically our 4 big asset classes where we're sitting in each of them. So cash, we've been building up over the year. So we're at sort of maximum cash levels, or we can go further, but we're certainly well above what would usually be in a cash, what would usually hold in a growth portfolio. There is, and that's been building up over the year. So as prices kept ticking up, we just sort of been taking bits off the top. Government bonds, we've been overweight government bonds, so it's not a big holding in this portfolio. It is a much larger holding than some of the other ones, but we've certainly got lots of them. Wasn't a great performer for the year, but the last couple of months have been pretty good as we've sort of had that view, and David's spoken numerous times on the blog about it, but that the RBA is on hold for a very long time, and quite possibly the next movement's down. And that's where we've had that view for a long time now, and that's sort of reflected in the returns you're starting to get on the government bonds, because there was a sort of the more general view was that yes, interest rates are going to start rising, and so you needed to factor that into your bonds. That's one area where we profit. And the other benefit of government bonds is if we do get a bit of a shakeout in the market, cash is great. You can use that as a bit of a war chest. Government bonds do tend to when equity markets fall, they tend to rise, and that sort of gives you a bit of an extra boost into the. So the idea is you're holding those with the view that when you get a shakeout, now we're switching in and using that to buy stocks more cheaply. So yes, we haven't done a lot on the bond side. The Aussie shares, we're minimum weight for Australian shares. Lots of questions about why hold any shares, Aussie shares at all. We do need to recognise that most investors we've got have Australian dollar liabilities, so and things can happen where we don't want to leave those people short if unexpected things happen. There's wars and there's financial crises that come out of the blue, and there's a reason for us to hold, to not feel as if we know exactly how things are going to go, and hedge ourselves. Having said that, though, we have a lot of investors who have sort of are on board with the whole get your money offshore, sort of as I've been saying, Aussie dollar falling, we want our money offshore, and you can just cut that out of your portfolio if you want. So with everything we've got in our portfolios, you can sort of go through and say, I don't like tobacco, I don't like uranium, pick whatever things you want to cut out, but you can also say, well, I actually don't want Australian shares, and maybe manage it yourself or not have it at all. And then finally, the international shares, where we're a lot more overweight at the start of the year. They got quite expensive in end of January, so start of February. We saw a big pullback in them. The difference between where we are now is sort of 6 months further on, but we've actually seen 10% added to earnings in the meantime. So we're roughly back to the same levels we were at the start of the year for international, but they're actually cheaper because earnings have kicked up another 10%. And for my part, there's still more to come on that earnings front. We haven't quite seen the end of that yet. So that's sort of where we're positioned, and we're largely trying not to do anything where we can. Like we're certainly tweaking around with our international shares, but we're trying to resist this urge to go. We've sort of set ourselves up for largely the environment that we've had, and as things start to actually happen the way we're expecting it, we're sort of trying not to overreact to it and saying, well, yeah, we've positioned our portfolio for that. We don't have to go and do something just because markets have moved in a particular direction. But yeah, for the large part, government bonds and Australian shares are relatively steady, pulling back on international shares and adding to cash. For Australia, so picking on the Australian markets, this part I've shown a few times. What it is it's 12-month forward earnings. So what I mean by that is you pick this time point at a consistent point in the future. So analysts forecast earnings for companies, and you at the moment they're forecasting 2019 earnings and 2020 earnings, and so we take a bit of 2019 and a little bit of 2020, and then next week we take a little bit less of 2019 and add a little bit more of 2020. So we've sort of got this constant basis of what we're expecting. And you can see that we really ripped higher in the mining boom back in 2007. So this has got then a very, very sharp drop relative to the US. A big recovery as China hit their stimulus, but since then it's pretty much been downhill and certainly in the last little while we sort of reconnected for a little bit for this 2015 to 2017 time period. Our earnings and US earnings sort of reconnected, but now we've separated. And so part of the reason for this, what I wanted to say is the Australian shares actually performed pretty well last year, but that was sort of despite the earnings decoupling rather than because of it. So if you then take that back to sort of a valuation method, and this is a very simplistic one where you just say what's the price of the Australian market divided by the earnings of the Australian market compared to the world. So basically when Australia is 10% cheaper than the world, you're sitting back here. And in 2003 that sort of happened, and Australian shares outperformed the world shares by 30%. Then they hit the top at about 10% overvalued, and they performed by 15% worse. 2 years later, we had another go at it, 40% better than the world. Next 2 years later, 33%, and that's where we're back to. So I guess what we look at on the Australian side is we think we largely got the fundamentals right. We didn't get the price right. Certainly international shares well outperformed Australian shares. They're sort of up 20-something% versus Australia. But Australia was up 14-ish%, which was a lot better than we expected. But that was despite the fundamentals. And so we're sort of, whenever things don't go the way we intend, we always need to sit back and go, well, is that because we think we've genuinely got something wrong? Or is it that we think we've got the fundamentals right and we just need to wait for the price to come to good? And so for this one, we're sort of sitting back and saying, well, we think we're calling it right. There might be a sudden earnings boom coming, but we think there isn't, and that those trends we've seen, the recent trends of decoupling, are set to continue. So international, this is a big one. So how do we know we're near the end of the boom. So we've got this, David sort of spoke a lot about this, the couple of different scenarios we can have. So we can have this twin sort of stimulus going on where China's spending a lot of money, which is going to stimulate commodity prices. US is spending a lot of money. They've both got these trade wars going on, and so money's bouncing around in different economies are getting thrown out by it. That gives one set of stocks a positive. In some of the other scenarios where we start seeing emerging market crises, you actually see pretty much the opposite stocks. You see all the resources stocks really suffer in that scenario, and especially Australian ones where we're competing with places like Brazil or Turkey or South Africa that produce a lot of resources. Their currencies suddenly drop 30%. All of a sudden they're selling their iron ore and their coal for 30% cheaper than what we can. So what we're trying to do on the international side is sort of take a two-stage, it's often called a barbell approach, where we say we want a bunch of low-risk stuff and then we want some high-risk stuff. We want to try and manage the two that we can get enough exposure to the upside without completely losing ourselves on the downside. So if things move quickly, we've got a bit of exposure. So we've got some downside protection. And then we can just sort of gradually shuffle between these. And that's what we've sort of been doing as well, is we've had this exposure to the US boom. There's a lot of stocks like Christian Dior and Michael Kors that are sort of high-end luxury goods where you've got this Trump boom going on, lots of tax cuts to the rich. So that's sort of one area we've been playing that. We've been playing it in a number of HR type companies. So there's Robert Half, which is a HR company. Paychecks, which basically does, what they do is, the US is very complicated with lots of different states, and if you've got a medium-sized company there, you don't want to have to try and work out the laws in all the different states to pay everyone. So these guys basically do that for you. So there's those types of companies where we're going, how can we get into this cyclical boom and get some exposure to that? We've got a fair bit of tech. We bought, so Apple's one of those ones where it's relative. When we bought it, it was cheap, but cheap as long as you don't think it's going to turn into Nokia or BlackBerry. That's the real issue with it. So that whole tech area moves quickly, and as we saw, like BlackBerry was, the top of the pops, and 2 years later nobody wanted them, so I worry about Apple in terms of that sense, but in the sense of I do think it's got a little bit more protection, and I do like the idea that Apple's not trying to outsell the most number of phones out there. I do like the idea that they're sort of going, we saw some new phones out today that are sort of $1,800 or something like that. They're better off being, I think they're better off being the Mercedes or the BMW of the thing. And they're probably a similar type of quality maybe between BMW's, Mercedes and say a Honda, but one of them sells for a much higher price and sort of restrict it and go for that brand image. And so I think I'd sort of like Apple on that front. BlackBerry and, sorry, not BlackBerry, Google and Facebook. So Facebook we bought sort of as recently as prices have fallen away. They've both definitely got lots of issues in terms of the antitrust. Government's going to be on them. Neither of them pay much tax. The European government's looking at these in lots of detail, but I just find it hard within those ones to find where you're going to stick your money online. I don't know if anyone here who's got teenagers or knows people with teenagers, talk to them about how often they watch free-to-air TV. They just don't. They've just got, I was taking my son and some of his mates, and they were talking about, they're sitting in the back of the car talking away to themselves, and they're talking about how one of the kids' dads just put a TV into the guy's room. And all the kids are like, yeah, but what's he going to do with it? Can he hook his computer up to it? What's he going to watch on that? Whoever watches free-to-air TV? It's all YouTube, it's all Instagram, it's all, it's online. And the advertisers know that. The advertisers are basically going, every month they're sort of saying, oh, well, take another couple of $1 million off my advertising budget for free-to-air TV and throw it online because the kids just aren't watching. And I don't know where they're going to spend the money. Like if it's not Google, if it's not Facebook, it's very hard to find where you're going to stick your money. So I think both of them have got issues. Both of them are going to have lots and lots of pressure on them, but very difficult to find where else. I won't go too much more. There's a lot of other tech stocks we've got in terms of semiconductors and things like that, which are very volatile, but they're also very cheap. So we've sort of got one side of that. The other side is how do we protect yourself in case of a bust? The traditional defensives are your utilities and REITs and things like that, horrendously expensive. We've steered clear of those, which was a good call. We thought we'd be clever and buy some telecommunications companies, and that really didn't work out very well for us, to be honest. We were hoping we'd sort of get a bit of defensiveness there, but to be frank, that's a troubled area as well. So what we've done instead is we've got a bit of healthcare. Consumer staples, what we've really been building up over the year, is things like Kellogg's, Kimberly-Clark, Unilever, all these people that all the new shampoos, new soaps, new toilet papers, and all that type of stuff, where individually they're not as stable, but we feel as if we put together a whole bunch of these guys into our portfolio, and that actually gives you a decent stability in terms of that. So yeah, so international, and it's almost sort of two barbells, because we're going, at one side we're saying lots of cash and lots of bonds, and we'll have lots of international, and then within the international we're also saying, okay, we just need to keep that lots of safe stuff, try and get a little bit of exposure. We want to try and get exposure if it kicks on for another, David spoke about scenarios, could kick on for another 18 months, 2 years. If we get a big infrastructure push in the US, $1 trillion of infrastructure, very possible, the boom keeps on going. So we don't want to give up that, but you don't want to be, the emerging markets crisis spirals out of control. You don't want to be left holding too many aggressive stocks in that scenario. So, actually I won't run, I'm probably running out of time. I won't run through this. This is just a I put this up every time, but I guess what I'm trying to say in this one is we're trying to run this portfolio so that to get the returns, and to be honest, I often use a thing to say, if the market's up 20%, I'm happy to be up 18% or 19%. You know, I'm happy to underperform or perform roughly in line with a rising market, because I want to structure the portfolio so that if we get the fall, that, you know, the markets fall 10%, that we're not the guys falling 15%. We're the guys sort of falling 5% in that scenario. So our idea is the portfolio should be, you know, tempered on the way up and give you protection on the way down. So the returns have been great, but we have actually come through with these. Each of these sort of means different things, but, you know, the volatility, basically, how much does your portfolio bounce around? We're sort of, you know, 20% less volatile than an equivalent ETF, which you could buy. There's sort of things about saying, you know, skews of returns, or kurtosis, which is a fat tails. Does your portfolio have fat tails where some days it's up a couple of percent and other days it's down a couple of percent? And so we're sort of dramatically, you know, thinner tails. So we tend to get those the day-to-day moves in our portfolio are not as big as what you see in the markets. So yeah, that's what we're trying for. I think we're roughly on the right path, and yeah, time will tell over how we go. And I'll pass across to Tim, who's got more of a fundamental, and then we'll jump to some questions.